If you have been reading any financial news in the last 12 months, you have heard of the name Cathie Wood without a doubt. This Wonder Woman from Wall Street had success after success after success. But as of recently, she had to face some headwind. And it looks like that the storm is not over yet. That and more in today's video, but before we dive in, please do me a favor, hit that like button, subscribe, click on the bell, click on all so that you don't miss anything. Leave me a comment or share this video with your friends if you think this is useful. Now without further ado, let's dive straight into today's content. In 1981, Cathie graduated summa cum laude on finance and economics at the University of Southern California. She started working in finance and worked her way all the way up to Chief Investment Officer of Global Thematic Strategies at Alliance & Bernstein, managing over $5 billion. At a certain point, she pitched an idea to invest more into tech and disruptive ideas, but Bernstein at the time thought it was too risky. So she quit her job and did it herself, and that was the beginning of Ark. When Ark was launched in 2014, Cathie soon became very famous because she was not afraid to invest into technology and disruptive ideas. Stuff like AI, robotica, crypto and electric vehicles like Tesla. Right now, Ark is managing somewhere between $50 and $60 billion, and the net worth of Cathie is approximately $250 million. Ark Invest is officially a hedge fund. But instead of the traditional hedge fund, which is only accessible for a handful of people, usually high net worth individuals, they wrapped Ark Invest into a handful of ETFs that are publicly traded so that it is accessible for the mass public. That idea is very great, and it opens up the doors for a lot of people in the world like you and me who want to buy in. But that exact same trade is right now also what is causing her so much headwind. Because in the latest news, the Fed is probably gonna rise interest rates to fight inflation. And therefore high beta stocks like tech, so stuff that moves up and down a lot, is now being sold. And because Cathie is so heavily into tech and disruptive ideas, her ETFs are now going down tremendously. The result, well, her most important ETF, the flagship of the entire store, Ark K, is right now down 15% for the year 2022. And since the peak, 12th of February 2021, the ETF already lost 47% against a 19% profit of the S&P 500. But if you would have bought the ETF just when it was launched in 2014, then you would have still been up fourfold your investment compared to the S&P 500, which rose 136%, so that's a bit more than a double on your money. And then let's have a look at some of the other ETFs that they're offering. Well, one is called the Ark W ETF, which focuses on next generation internet. It fell all the way down from $187 to $100, which causes a loss of 46%. The ETF Ark F ETF, which is focused on fintech innovations, fell down from $63 to $36, causing a loss of 43%. The next one, RQ ETF, well, not much better. It focuses on autonomous tech and robotica. It fell from $99 to $72, causing a loss of 28%. And if you would have invested into the Ark G ETF, which focuses on genomic revolutions, then your ETF would have dropped from $112 to $52, causing a loss of 54%. Extra painful, of course, that all the ETFs are down compared to one of the best peers of the S&P 500 ever measured. But when I start to dig deeper into the most important ETF, the Ark K ETF, this is the flagship of the store, I found some disturbing stuff. Right here you see a picture of the 10 biggest holdings in that ETF. And those 10 biggest holdings weighted together are more than 50% of the total ETF. Now I've plotted these 5 stocks into a graph compared to the Nasdaq, and the Nasdaq is the index where a lot of tech stocks are being traded. And the black line in the graph is the Nasdaq index, and as you can see, actually the only stock that outperformed the Nasdaq was Tesla with a gain of a little bit more than 25%. Other than that, all the others went down, causing a loss of 50 to 65%. And if we look at the second half of the top 10, so number 6 to number 10, well, then it doesn't look much better. Again, the black line in the graph is the Nasdaq index, and the color-coded lines are the stocks. And you can see that pretty much every stock is in the red, also causing losses from 35 to 40, and at some moment even sales of 45%. Which we can come to the conclusion that if Cathie wants to turn this around, she doesn't need to have one stock that goes up, she needs to have an entire bag of stocks that's going through the roof if she still wants to save the situation. Because like I said earlier, the fact that she turned it into an ETF is great so that everyone can get in, but it's also right away her weakness. Because that is what makes a big difference between her fund and the traditional hedge funds on Wall Street. Because her competitors can actually sell or short the stocks that she has in her ETF. So if they start dumping all of the stocks that she has, then she has no other choice than also sell the stocks that she has or just cover the losses, because she's obligated to follow the rules and regulations that come together with having an ETF. Whereas a traditional hedge fund can just literally close the doors and say, right now, no one is leaving, no one is entering. We will open up the doors again once the situation calms down. But because the ETF is publicly traded, everyone can just buy and sell whenever they want. And Cathie is actually with her back against the wall. She needs to sell those positions to cover the losses and follow the rules. Now she could decide to delist the ETF, but right now, in my opinion, that wouldn't make any sense, because right away that would mean the end of the fund. And to make things even worse, this picture right now is circulating over Twitter showing that insiders are still selling the ETF and all rushing to the exit. Now, why is this significant? It is because insiders are seen as people who are close to the fire, who know more than you and me. That are usually CEOs, COOs, large shareholders, people who are really close to the business and know everyone in and out. And remarkably enough, Cathie Wood is not stressing at all, because she says she has a 5-year investment horizon. According to her, the market right now is irrational, and she said she is quote-unquote attacked by algorithms. And what she means with that is that the market is usually algorithm driven, and I have to say I kind of agree with that, because big investment funds, pensions, banks, if they trade on the stock market, they don't always click on buy and sell with every trade. There are algorithms sometimes who do that and who find the certain positions in the stock. So I totally get what she means with it. But she says that those algorithms are searching for companies that have a lot of cash on the balance, or are able to burn some of the cash that they have on the balance sheet, and therefore are now buying and selling very short term, and therefore selling off her stocks that she has in her ETF. So she's kind of the victim of those algorithms right now, selling off all the stocks. Well, it gets a little bit technical and complicated. The thing is just that she says that the downturn is due to algorithms who trade very short term, and she looks on a much longer term, 5 years, on every investment decision that she makes. And in the latest interview that she gave, she wanted to stress out that she is still aiming with her fund for an annual return of, hold on, 40% a year. Now, if she was able to manage that, that will be an absolute home run. But after the recent decline in the last 12 months, she still has a long way to go. And if we look deeper into the market and we compare a hedge fund to an index, then we see that hedge funds cannot beat the market on a consistent base. So they might beat the market 1 or 2 or 3 years in a row, but no one can really do that 10, 20, 30 years in a row. And to be honest, frankly, it doesn't matter which chart you pull up or which hedge fund you pull up. At a certain point, you see that they're kind of just underperforming compared to the most important indexes. And I always like to take it as an example, the S&P 500. Matter of fact, world's most successful and famous investor, Warren Buffett, and yes, he is running a hedge fund, said once in an annual letter to his investors, a number of smart people are involved in running hedge funds. But to a great extent their efforts are self-neutralizing and their IQ will not overcome the cost they impose to investors. Investors, on average and over time, will do better with a low-cost index fund than with a group of funds. So knowing this, and if when it comes out of the mouth of the quote-unquote biggest and best investor ever, you might be wondering yourself, why would you ever put your money into a hedge fund if an ETF is much cheaper and will beat all the hedge funds in a consistent basis over a long period of time? Well, let's look at the graph of Barclays again that you saw earlier. There are two critical moments that kind of stand out. Where you can see that Barclays is beating the market is during the internet bubble in 2000 until 2002 and the crash in 2008. So it looks like the fund can manage crisis better than the market can, which kind of makes sense, because if you have, let's say, an ETF on just an index, then you are going down together with the market. But the hedge fund, at the moment the market is crashing, can just sell off all the stocks and go into cash, or rotate into more defensive stocks so they can kind of limit the loss. But this is actually very hard to time, because no one knows when the next crisis will be. No one knows when the stock market will turn, and we will have maybe years of a negative return. Matter of fact, according to one of the other most successful investors in the world, the market should have crashed already 100 times. Yes, I'm looking at you, Ray Dalio. Matter of fact, it will be almost impossible to time the market and to rotate from an ETF into a hedge fund so they can kind of drive you through the crisis with as less damage as possible, and then rotate out of the hedge funds again back into ETFs, where the hedge funds will also ask you to pay an entrance fee, usually 1 or 1.5%, an exit fee, sometimes also 1 or 1.5%, and of course the performance fee. So yeah, it seems almost undoable and just not logical to try to rotate in and out of hedge funds from ETFs. Now, on full transparency, I have never bought, hold or sold any of Cathie Wood here ETFs, and I will most likely also not do so. And of course, nothing in this video is financial advice, but from an outsider trader's perspective, I will do the following. If you believe in Cathie and her team and her ETF, and you saw your portfolio just being cut in half, then this actually will be a great opportunity to buy in more and just kind of buy the dip. If you have a long-term horizon just like her, where you're looking forward for another 5 years, hoping that she might be able to give you that 40% annual return. If you think she will not be able to turn things around and her competitors will keep selling the tech stocks that are in the ETF, that the insiders rushing to the exit is the sign that everything will go down under, then although it's painful, my advice will be to cut your losses, sell the ETF, and try to wait for the next investment opportunity. And of course, always be sure to diversify, so that in case you are invested in this ETF and you need to take the loss, that this is not too much of a big part of your total investment portfolio. Try to diversify as much as you can into other ETFs, indexes, stocks, maybe crypto, real estate, trying to kind of create this all-weather portfolio for yourself, that in case something goes wrong like this, that your account will not be blown up or you get yourself into trouble. And with that being said, that was it for today's video. Please let me know what you think in the comments. Do you think this is the end for Ark Invest and Cathie Wood, or is she able to turn things around, and is this just a great buying opportunity 5 years from now? I'm very curious. And when you're down there anyways, also please do me a favor, hit that like button, subscribe, click on the bell, click on all so that you don't miss anything, and I'll see you guys in the next one. Thank you. Bye bye.